The Volatility-Triggered Technical Rebalance Hybrid Framework, or VTTR-H, we are about to deconstruct, is a theoretical quantitative asset allocation model. It is presented here strictly for educational system analysis, not as financial advice. This split-screen graph illustrates the primary dilemma of holding leveraged exchange-traded products. On the left, standard assets produce relatively stable growth. On the right, leveraged ETPs offer massive upward momentum during bull runs, but they inevitably suffer from a mathematical certainty: volatility decay. Volatility decay, also known as beta slippage, occurs because these funds reset their leverage daily. During choppy or downward markets, the daily compounding of negative returns mathematically destroys the long-term holding value of the asset. To solve for this decay, the VTTR-H framework operates as a fully automated asset allocation model. It is engineered specifically to target a predictable, money-weighted internal rate of return of 15% or higher. The core thesis of the strategy relies on strict separation. It neutralizes leverage decay by decoupling long-term wealth accumulation entirely from acute beta exposure, governed by a rigid, unyielding execution script. By utilizing automated logic gates, the framework removes human emotion from the trading equation. It systematically converts systemic market panics from a portfolio threat into a mechanical accumulation driver. Building this architecture starts with a foundational capital mechanism. The system relies on a strictly automated dollar-cost averaging script, injecting exactly $1,000 of new capital per month. Looking at this capital dashboard, we can see the primary allocation split. 60% of that monthly injection, or $600, flows directly into a designated reservoir known as the core vault. The first half of that core vault allocation splits evenly. $150 purchases SPY to capture foundational broad market beta, and $150 goes into QQQ to secure mega-cap technology and secular growth momentum. The second half allocates $150 into SOXX, acting as a high-beta secular growth driver within the semiconductor space, and the final $150 purchases COWS. COWS functions as the defensive anchor of the vault. It tracks U.S. companies with deep free cash flow yields, which mitigates the heavy technology concentration of the other three assets and provides resilience during inflationary regimes. Together, these four assets form the core vault. They serve as the permanent, unleveraged capital base of the strategy, mathematically isolated from the risks of the active portfolio. That leaves the remaining 40% of the monthly capital injection, $400, which operates under an entirely isolated mandate. Panning over to the second reservoir, this pipeline fills the Volatility Engine. This is a hyperactive tactical sleeve engineered strictly to harvest short-term market velocity. Inside this engine, $100 is allocated to SSO, providing 2 times daily leverage on the S&P 500, and $100 goes to QLD for 2 times daily leverage on the NASDAQ 100. The final $200 pushes the leverage higher. $100 buys SPXL for 3 times daily S&P 500 exposure, and $100 purchases TQQQ for 3 times the NASDAQ 100. The system enforces one crucial operational constraint here. These 4 highly volatile assets are never treated individually. They are monitored strictly as a single consolidated portfolio unit. Monitoring the Volatility Engine as a single unit is the architectural prerequisite for neutralizing the beta slippage. It prevents the system from triggering early, based on the isolated noise of a single asset. The structural problem is clear. The system must extract momentum value from these leveraged assets before they succumb to volatility decay and microtransaction tax drag. This flowchart maps the solution: the Technical Rebalance Protocol. It is a strict, programmatic script that governs the Volatility Engine through a dual-trigger audit. Condition A, the breakout. The first logic gate opens if and only if any single asset in the Volatility Engine achieves a positive 30% unrealized gain relative to its specific cost basis. Condition B, the aggregate profit. The second logic gate requires the absolute combined profit of all 4 assets in the engine to simultaneously exceed $1,000. If both conditions are met, the script executes. It initiates a consolidated divestiture, instantly liquidating 100% of the Volatility Engine. To handle the tax burden, the script immediately provisions a 30% short-term capital gains tax liability on that aggregate realized profit. The net post-tax proceeds are then permanently rotated out of the engine and distributed equally across the 4 stable assets of the core vault. This mechanical sweep actively removes human greed from the process. It ensures that temporary momentum spikes in highly volatile instruments are permanently converted into unleveraged equity before the market inevitably corrects. But executing a strategy with triple leveraged assets introduces massive downside risk during systemic black swan events, like the 2008 global financial crisis. The system has to survive the crash. To do this, the architecture includes a final structural pillar, the tactical reserve. This is a $10,000 base of yield-generating short-term treasuries kept strictly as dry powder for systemic crises. The model utilizes the CBOE VIX index as a deterministic, quantitative trigger to deploy this reserve capital. This line graph tracks the VIX scale in script. For Tier 1, when the VIX spikes past 30.00, the script forces a $3,333 tranche from the tactical reserve directly into the market. For Tier 2, a VIX breach of 35.00 forces a second $3,333 tranche to deploy. And for Tier 3, extreme panic, driving a VIX breach of 40.00, forces the final $3,334 tranche into the market. There is one critical operational constraint. Each tier may only fire once per calendar year. This mechanism prevents cascading liquidations and premature capital exhaustion during prolonged drawdowns. By linking liquidity injections strictly to fixed thresholds, the architecture bypasses human panic entirely. It algorithmically buys assets at points of maximum historical discount. To validate this architecture, we run the model through a 20-year institutional stress test, spanning from April 2006 to April 2026. This specific time horizon purposefully subjects the VTTR-H model to the extreme downside volatility of both the 2008 and 2022 market crashes. Reviewing the performance data table, the system executed approximately 38 total engine sweeps. Roughly $310,000 in total invested capital resulted in a net portfolio value of approximately $1.85 million. That output achieves the target money-weighted internal rate of return of 16.2%. The primary critique of this model is its aggressive tax inefficiency. During this test, the system generated approximately $125,000 in short-term capital gains tax liabilities. But within this framework, paying that tax is a structural feature, not a bug. It functions as an algorithmic insurance premium, legally mandating that profits are extracted from radioactive leveraged vehicles before they decay. The efficacy of the VTTR-H model relies entirely on programmatic adherence. It requires overriding emotional bias with cold dual constraint logic. That structural discipline is the mechanism that converts systemic market volatility into permanent unleveraged equity.